Welcome to the Deep Dive. Today we're tackling a core concept in business finance, liabilities. Now, you might just think debt, like a credit card bill, but for companies, it's much broader. Think probable future sacrifices of economic benefits. Sounds complicated,
This
right?
can sound a bit formal, yeah.
Exactly. So our mission today is to really break down this world of company liabilities. We'll go from the everyday stuff to the really complex long-term promises, even uncertain possibilities. We want you to walk away understanding what these are and, maybe more importantly, why they matter so much for a company's financial picture. Ready to jump in?
Let's do it.
Okay, let's unpack this. What's the fundamental definition of a liability in the business world? How do we translate probable future sacrifices into, plain English?
That's a good starting point. Essentially, a liability is an obligation a company has to someone else. It's a commitment to pay money or provide services in the future. But the key is it stems from something that already happened. A past transaction or event created this present obligation. It's not just a potential future cost. It's something they're already on the hook for.
Okay, so present obligation from a past event.
Got it.
Right. And for reporting, we split them mainly into current liabilities and non-current liabilities. Current liabilities are the ones expected to be settled relatively soon, usually within the next year, or within their normal business cycle, whichever is longer. Settling them usually means using current assets like cash or maybe taking out another short-term loan.
So why is this distinction, especially knowing the current debts, so critical for, judging a company's strength, its
And
ability to survive day to day? It's absolutely vital. Current liabilities give you a snapshot of the company's immediate financial pressure. Can they cover their upcoming bills, their payroll, their suppliers, investors, lenders, management? Everyone watches this closely. It's a key indicator of liquidity and short-term solvency.
makes sense. So we've got the foundation. Let's get into the specifics. What are some of these common current liabilities we see all the time?
Okay, probably the most common is trade accounts payable.
Right.
This is simply money owed to suppliers for things like raw materials, inventory, office supplies, stuff bought on credit in the normal course of business. Usually there's no formal promissory note involved.
Just an invoice and a promise to pay.
Exactly. And companies often get offered cash discounts if they pay these quickly, like, say, within 10 days. How they account for these discounts, whether they record the purchase initially at the full amount or net of the potential discount, tells you something. Consistently taking discounts, that suggests good cash management.
Okay, so accounts payable is like an informal IOU. What about something more formal?
That would be trade notes payable. These also often arise from purchases, but they're backed by a formal, written promise, a note specifying the amount, the due date, and often a stated interest rate.
Like a mini loan from a supplier.
Pretty much. So if a company, let's call it Dogs and Cats LLC, borrows $50,000 via a 12-month, 5% note, they record that note payable. And as time goes by, even before they make a payment, interest starts building up. That accrued interest becomes interest payable, another current liability, especially if an interest payment date falls after their year-end reporting date.
Okay, and what about long-term debt? I sometimes see parts of it listed as current. How does that work?
Yes, the current portion of long-term debt. Good point. If a company has, say, a 5-year loan that requires annual principal payments, the payment due within the next 12 months gets reclassified from long-term debt to current liabilities.
So it reflects the immediate obligation.
Precisely. It shows what's coming due soon. Now, there's a bit of nuance here under U.S. GAAP. Sometimes a company can keep a short-term obligation classified as non-current if they genuinely intend to refinance it on a long-term basis, and they have the proven ability to do so.
How do they prove that?
Usually by actually refinancing it before the financial statements are issued, or by having a solid, non-cancelable financing agreement already in place. It's something to watch for in the notes. It can make a company look a bit more liquid than it might otherwise be.
Interesting. Okay, this next one seems really common, especially thinking about payroll or monthly bills. What about accrued liabilities, also called accrued expenses?
Yes, these are super common. They represent expenses that the company has incurred. They've received the benefit, but they just haven't paid the cash yet.
Like the electricity bill for December that arrives in January?
Exactly. Utilities, rent, insurance. And a big one is salaries and wages. Imagine an employee works the last 3 days of December, but their weekly paycheck covering those days isn't issued until January 5th. At December 31st, the company owes the employee for those 3 days. So they record salaries and wages expense and a corresponding liability, salaries and wages payable. It matches the expense to the period the work was done.
Got it. Matching principal in action. What about taxes?
Definitely another big category. Taxes payable. This includes things like property taxes payable. Companies often accrue these monthly, even if the bill only comes once or twice a year, again, to smooth out the expense. But a really important one for many businesses is sales taxes payable.
The money they collect from customers.
Right. When a store charges you sales tax, they're collecting it on behalf of the government. That money isn't their revenue, it's held in trust. So if a jewelry store sells a $10,000 bracelet plus 7% tax, they collect $10,700. But $10,000 is revenue, and that $700 immediately becomes sales tax payable, a liability they owe to the state or local government. It's never the company's money.
That's a critical distinction. Okay, what else falls under employee-related liabilities?
Well, besides accrued salaries, there are the employer's payroll taxes. This is stuff like the employer's share of Social Security and Medicare, plus federal and state unemployment taxes. These are definitely an operating expense for the company.
Okay, that's the company's cost.
Yes. But then you have payroll deductions, things withheld from the employee's paycheck, like their share of FICA and Medicare, income tax withholdings, maybe 401k contributions. The company collects these, but they're not the company's expense. They're liabilities, amounts owed to the government or other entities on behalf of the employee. The company is just the middleman.
Right, holding the money temporarily.
Exactly. And don't forget bonuses. If a company promises bonuses, often tied to profits, that becomes an expense and a liability once earned. The calculation can be tricky, actually, because the bonus is usually based on net income, but the bonus itself is an expense that reduces net income.
Sounds like a lot of...
It is. There are formulas to handle it, but it highlights how interconnected these things are. The bonus expense has to be factored in to arrive at the final net income figure used to calculate the bonus itself.
Okay, one more common. Current one vacation time.
Accrued vacation. Yes. If employees earn vacation time this year that they can carry over and use next year, the company generally has to record a liability for that earned but unused time this year. There are specific criteria, but basically if the time is earned, the right to it vests or accumulates, payment is probable, and the amount can be reasonably estimated, then it needs to be accrued. It recognizes the cost of that benefit in the period the employee earned it.
Makes sense. Any other common current ones?
Maybe just a quick mention of self-insurance liabilities. Some large companies choose to bear certain risks themselves, like maybe the first chunk of workers' comp claims or warranty costs, rather than buying traditional insurance for everything. They still need to estimate and accrue a liability for expected losses from claims already filed or likely to occur based on past experience. It's like creating their own internal insurance reserve.
Okay, that covers a lot of the day-to-day stuff. Now, shifting gears. Some liabilities feel less routine, more tied to big strategic moves or really long-term stuff. Let's explore those specialized obligations.
Absolutely. A significant one can be liabilities related to exit or disposal activities.
Like shutting down a factory or a whole division.
Exactly. These aren't just operating costs. They involve specific, often large expenses like termination benefits for laid-off employees, costs to get out of contracts early, or costs to relocate operations. Now, the key here is timing. A company can't just record a liability because they plan to restructure. No, there needs to be an actual obligating event. For instance, they have to formally announce the plan and the termination benefits to the affected employees. That communication creates the present obligation.
So the commitment has to be real, not just an idea.
Precisely. And once recognized, this liability is measured at fair value, and companies need to disclose a lot about it, what they're doing, the costs involved, how it impacts results. It helps investors understand the scope and financial hit of the restructuring.
Okay. What about those really long-term cleanup costs, like for environmental issues?
Ah, yes, asset retirement obligations, or AROs. These are fascinating. They're legal obligations tied to the eventual retirement of a tangible, long-lived asset. Think decommissioning a nuclear power plant decades from now, or reclaiming land after a strip mining operation finishes, or dismantling an offshore oil rig.
Costs that are way, way off in the future.
Exactly. But the obligation exists today because the company is operating that asset today. It meets the definition of a liability. There's a duty, they have little choice but to eventually pay, and the obligation arose when they started using the asset.
So how do they account for a cost that might not happen for 30 years?
Great question. They have to estimate the future cost and then calculate its present value using an appropriate discount rate. When they first put the asset into service, they record two things: an increase to the asset's cost, called asset retirement cost or ARC, and the liability, the ARO itself, both based on that present value estimate.
Wow, okay, so the future cost impacts the asset's value today.
Yes. And then, over the asset's life, two things happen each year. First, the ARO liability increases through accretion expense. Think of this like interest expense. The present value amount grows over time towards the full future estimated cost.
So the liability gets bigger each year.
Correct. And second, the ARC part, which was added to the asset's cost, gets depreciated along with the rest of the asset. It's a complex but logical way to ensure the total cost of using the asset, including its eventual retirement, is spread over its useful life. It matches the expense to the periods benefiting from the asset.
That's quite something, accounting for things decades away. Okay, what about uncertainties, money you might owe or even money you might receive? How does accounting handle situations that depend on future events?
That's the realm of contingencies. A contingency is basically an existing situation with an uncertain outcome, either a potential gain or a potential loss that will only be resolved by some future event happening or not happening.
Lawsuits seem like a classic example.
Absolutely. Pending litigation, product warranties, potential environmental fines, even the risk of customers not paying their bills. Those are all common loss contingencies. GAAP has specific rules based on how likely the loss is. There are 3 levels. First, probable. This means the future event confirming the loss is likely to occur. If a loss is probable and you can reasonably estimate the amount, you must record a liability and an expense now.
Even before it's certain.
Yes,
Yeah.
conservatism principle. If there's a range of possible loss amounts, you accrue the best estimate within that range. If no amount in the range is better than any other, you accrue the minimum amount and disclose the potential for the higher loss.
Okay, so probable and estimable means book it. What if it's less likely?
If the loss is reasonably possible, meaning more than remote, but less than likely, you don't record a liability. However, you must disclose the situation in the notes to the financial statements. You describe the contingency and provide an estimate of the possible loss or state that an estimate can't be made.
So disclose but don't record.
Right. And finally, if the chance of loss is remote, just a slight possibility, then generally no disclosure is needed. The main exception is for certain guarantees, like guaranteeing someone else's debt. Those often require disclosure, even if remote.
Let's take that lawsuit example. Say Alton Company is sued for $3 million. Their lawyers think losing is probable and estimate the loss at $2.2 million, though it could reach $3 million. What happens?
Okay, it's probable and estimable. They would immediately record a $2.2 million loss in liability. They would also need to disclose in the notes that the potential loss could go as high as $3 million. Transparency is key.
Got it. Now what about the flip side, potential gains, like if they expect to win a lawsuit?
Gain contingencies. The rule here is much stricter, more conservative. You do not recognize gain contingencies in the financial statements until they are actually realized or resolved.
Why the difference?
It's the conservatism principle again, and revenue recognition rules. You don't want companies booking income that's still uncertain. It could be misleading. So gain contingencies are usually just disclosed in the notes and very carefully so as not to imply they're guaranteed.
Okay, no booking uncertain gains. Makes sense. You mentioned warranties earlier as a loss contingency. Are there others like that?
Yes, warranties and things like premiums or rebates offered to customers are common loss contingencies. Because companies usually have past experience, they can often reliably estimate the future costs associated with these promises. For premiums like offering a free item if customers send in mock tops, companies estimate how many offers will likely be redeemed and accrue a liability for the cost of those future redemptions. For warranties, the idea is crucial. The estimated cost of fulfilling warranties on products sold this year should be expensed this year.
Even if the repairs happen next year or later?
Absolutely. It matches the warranty expense with the sales revenue it relates to. So they estimate the future warranty costs based on past experience, say 3% of sales, and record that entire liability in the year of the sale. The balance in the warranty liability account then goes down as actual repairs are made later.
That matching concept is powerful. Okay, let's zoom out again. We've talked current, specialized, uncertain. What about the really big long-term financial promises? This feels like where time value of money really kicks in.
You're absolutely right. Time value of money, TVM, is fundamental here. The basic idea, as you know, is that money available today is worth more than the same amount in the future because of its potential earning capacity. This concept is critical for valuing long-term liabilities like bonds, long-term notes, leases, pensions, anything involving cash flows stretched over many years. We need to figure out what those future payments are worth today.
And you use present value calculations for that, right?
Exactly. Present value of a single future amount or present value of an annuity, a series of equal payments. And we even distinguish between ordinary annuities, payments at the end of each period, and annuities due, payments at the beginning.
Can you give a quick example of how this helps a company make a decision, say, evaluating an offer?
Sure. Imagine a company has equipment currently worth $300,000. Someone offers to buy it for $500,000, but payment won't be for 4 years. If the company knows it can reliably earn, say, 10% interest on its investments.
They need to know today's value of that future $500.
Precisely. Using a present value calculation, that $500,000 in 4 years, discounted at 10%, is only worth about $341,500 today. Since $341,500 is more than the current $300,000 value, the future payment offer looks potentially attractive, even after accounting for the time value of money.
That really clarifies the decision. And you mentioned annuities for things like leases. Does timing matter there?
Hugely. Let's say a company signs a 10-year lease, $100,000 annual payments, 10% interest rate. If payments are due at the end of each year, an ordinary annuity, the present value of all those payments is about $614,500. But if the payments are due at the beginning of each year, an annuity due, the present value is higher, around $675,900. Because they have to pay sooner, the present value of the obligation is larger. Details matter.
Okay, so TBM is key for long-term stuff. Let's talk about long-term notes payable. How are they different from the short-term ones?
Well, the main difference is duration, obviously. But the accounting principle is the same. They must be recorded at present value when issued. This becomes especially important when a note is non-interest bearing, or if it carries an interest rate that's clearly way below the market rate for similar borrowing.
What do you do then?
Yeah.
You can't just use the stated rate if it's unreasonable.
No, you have to impute interest. You use a realistic market-based interest rate to figure out the note's true present value. For example, a company gets a machine by issuing a $10,000 5-year non-interest-bearing note. If the market rate for this company's borrowing is 10%, that $10,000 future payment is only worth about $6,210 today. So the machine is recorded at $6,210. The difference, $3,790, is recorded as a discount on notes payable. It represents the interest that's implicitly built into the deal, even though it's not stated.
And that discount doesn't just sit there, right?
Correct. It gets amortized, gradually recognized as interest expense over the life of the note, typically using the effective interest method. Each period, you calculate interest expense based on the note's carrying value and the effective market rate. This expense reduces the discount and increases the note's carrying value, eventually bringing it up to the full $10,000 face value by the maturity date.
Yeah.
It reflects the true economic cost of borrowing over time.
This sounds like how bond discounts work, too. But before bonds, let's talk about something lenders use to protect themselves. Debt covenants. These seem fascinating and maybe a source of trouble sometimes.
They absolutely are. Debt covenants are conditions or restrictions included in loan agreements by the lender, the creditor, to protect their investment. They essentially limit what the borrower, the debtor, can do to reduce the risk of default.
What kind of limits are we talking about?
Oh, lots of things. They might require the company to maintain certain financial ratios, like a minimum current ratio or a maximum debt-to-equity ratio. They might restrict further borrowing, limit dividend payments to shareholders, or require certain assets to be kept as collateral.
And what happens if a company messes up and violates a covenant?
Technically, they're in technical default. This usually gives the lender the right to demand immediate repayment of the entire loan.
Wow, that's serious.
It is. But in practice, lenders often prefer not to push a struggling company over the edge. More commonly, a violation triggers negotiations. Maybe the terms are adjusted, maybe the company gets a waiver if it's temporary, but it definitely gives the lender significant leverage. They use these covenants to monitor the borrower's health and step in if things look shaky.
All right, a crucial protection for lenders. Okay, let's move to the really big one for long-term corporate finance, bonds. How do these work as a giant IOU system?
Bonds are a primary way for large companies and governments to borrow significant amounts of money from a wide range of investors. Think of it as slicing up a very large loan into smaller, tradable pieces. There's some key terminology. The bond indenture is the legal contract detailing all the terms. The face value, or par value, is the amount repaid at maturity, and it's usually the basis for calculating interest payments. The stated interest rate, or coupon rate, is the fixed percentage of face value that the company pays in cash interest to bondholders.
Okay, face value and stated rate are fixed in the contract.
Right. But the price the bond actually sells for when first issued and the real rate of return an investor earns depends on the market interest rate, or effective rate or yield, at that time. This is the prevailing rate for similar bonds with comparable risk.
And this is where discounts and premiums come in.
Exactly. If the market rate is higher than the bond's stated rate, investors won't pay full face value for a bond paying less interest than they could get elsewhere. So the bond sells at a discount below face value. This means the company's actual interest expense will be higher than the cash interest paid.
Makes sense. They have to offer a discount to compensate for the lower coupon.
Correct. Conversely, if the market rate is lower than the bond's stated rate, the bond is attractive. It pays more than comparable new bonds. Investors will bid the price up, and it sells at a premium above face value. Here, the company's actual interest expense will be lower than the cash interest paid.
Got it. Market rate drives the price relative to face value. Are there many different kinds of bonds?
Oh, absolutely. Debentures are unsecured bonds backed only by the company's general creditworthiness. Mortgage bonds are secured by specific assets, like real estate. Convertible bonds give the holder the option to exchange the bond for a set number of shares of the company's common stock. Term bonds mature all on one date, while serial bonds mature in installments over several years. There are even zero-coupon bonds that pay no periodic interest. They're just sold at a deep discount and redeemed at face value.
Lots of variety. So when a company issues bonds, how do they calculate the selling price?
The selling price is the present value of all the future cash flows the bondholder expects to receive. That means the present value of the lump sum principal repayment at maturity, plus the present value of the stream of regular interest payments, the annuity. And crucially, both of these present value calculations use the market interest rate at the time of issuance, not the stated rate. That's what determines whether it sells at par, a discount, or a premium.
Okay. What about the costs of issuing bonds? Legal fees, underwriting fees?
Those are bond issuance costs. They're treated as a reduction from the bond's carrying amount on the balance sheet, similar to a discount. They effectively reduce the cash proceeds the company receives. These costs are then amortized, meaning they're spread out as additional interest expense over the life of the bond, usually using the effective interest method. It increases the overall effective cost of the borrowing.
So both discounts and issuance costs increase the effective interest expense over time, and premiums decrease it. How is this amortization actually done?
There are two methods. The simpler one is the straight line method. You just take the total discount or premium and divide it by the number of periods the bond is outstanding. This gives you the same amount of amortization each period, resulting in a constant dollar amount of interest expense recognized.
Simple, but is it allowed?
It's allowed under U.S. GAAP only if the results aren't materially different from the other method, which is the effective interest method. And GAAP generally requires the effective interest method.
Why the preference for the more complex method?
Because it more accurately reflects the economics of the bond. With the effective interest method, the interest expense recognized each period is calculated by multiplying the bond's carrying value at the beginning of the period by the effective market rate established at issuance. The difference between this calculated interest expense and the actual cash interest paid is the amount of discount or premium amortized for that period.
So the interest expense amount changes each period, even if the cash payment is fixed.
Exactly. But the rate of interest expense relative to the carrying value stays constant. As the carrying value changes, moves towards par, the dollar amount of interest expense also changes. It provides a much better picture of the true interest cost over the bond's life. Bond issuance costs are just factored into this calculation, reducing the initial carrying value.
Okay, that makes sense why it's preferred. Are there any other tricky timing issues with bonds?
A couple of common ones. Sometimes bonds are issued between interest dates. If a bond pays interest, say January 4th and July 4th, but it's issued on April 4th, the buyer pays the seller for the 3 months of interest that have already accrued, Jan 1 to April 1. Then on July 1st, the buyer receives the full 6 months of interest. It just ensures interest is allocated correctly. Also, similar to notes, you need year-end bond interest accrual. If the company's year-end, say DEXUP 31, falls between interest payment dates, they need to make an adjusting entry to record the interest expense incurred and the discount premium amortization for the partial period up to year-end.
Got to make sure everything lines up for the financial statements. And how is all this debt usually presented?
Often, companies will just show a single line item for bonds payable or long-term debt on the face of the balance sheet. But the crucial details, maturity dates, interest rates, collateral, conversion features, covenants, all of that has to be disclosed in the accompanying notes. Transparency is key.
Absolutely. Okay, now let's look at the end of a debt's life cycle, or maybe a difficult middle. What happens when companies struggle with debt or want to pay it off early?
This brings us to troubled debt restructuring, TDR, and extinguishment of debt.
TDR sounds troubled.
It usually is. A TDR happens when a creditor, seeing that a debtor is in financial difficulty, grants concessions that they wouldn't normally consider just to improve the chances of getting something back. Concessions might involve reducing the interest rate, extending the payment deadline, or even forgiving a portion of the principal amount owed.
How does the debtor account for this break they're getting?
It depends on how the debt is restructured. If the debtor settles the debt by transferring assets, like giving the creditor land instead of cash, or by transferring an equity interest, giving them shares of stock, then the debtor usually recognizes a gain on restructuring. This gain is the difference between the carrying amount of the debt, including any accrued interest, and the fair value of the assets or equity giving up. In these cases, the original debt is considered extinguished, settled.
Okay, so debt wiped out, possibly a gain recognized. What if they just change the terms?
If it's just a modification of terms, lower interest, longer repayment period, maybe some interest forgiven, but the principal amount remains, the accounting is different. The debt is not considered extinguished. The debtor accounts for the changes prospectively. They only recognize an immediate gain if the total future cash payments required under the new terms, undiscounted, are less than the current carrying amount of the debt. If there is such a gain, then future cash payments just reduce the principal balance. No further interest expense is recognized because the effective interest rate becomes 0 or negative.
Interesting. So modifying terms is generally less impactful immediately unless the total future payments drop below the current debt balance.
Right. Now, separate from TDRs is the more general extinguishment of debt. This simply means the liability is removed from the books. It's extinguished if the debtor pays the creditor, or if the debtor is legally released from the obligation. Importantly, a modification of terms, like we just discussed, is generally not considered an extinguishment.
What about paying off bonds early? Does that count?
Yes, paying off bonds before maturity is a common way debt is extinguished. If bonds are paid off at maturity, the carrying value usually equals the face value, so there's no gain or loss. But if bonds are extinguished before maturity, maybe the company calls them back or repurchases them on the open market, there's usually a gain or loss.
How is that calculated?
It's the difference between the reacquisition price, the amount paid to buy back the bonds, including any call premiums and fees, and the net carrying amount of the bonds on the books at that time, face value adjusted for any unamortized premium, discount, and issuance costs.
Yeah, so if they pay less than the carrying amount, it's a gain. More, it's a loss.
Exactly. Paying off debt early can result in significant gains or losses depending on interest rate movement since the bonds were issued. A company might repurchase bonds trading at a discount in the market and record a nice gain, or they might have to pay a premium to call bonds back early, resulting in a loss. It reflects the economic consequence of retiring the debt early.
Fascinating how market rates impact even the retirement of debt.
Mhm.
Okay, last major topic, and it's a big one that's seen huge changes. Lease accounting, specifically for the lessee, the company using the asset. Renting an office seems simple, but the accounting sounds complex now.
It absolutely is, much more so than it used to be. The biggest change under recent standards, particularly US GAAP, is that companies now have to recognize assets and liabilities for almost all leases right on their balance sheet. Before, many operating leases were effectively off balance sheet.
So potentially a lot more debt showing up on balance sheets now.
Definitely. A lease, fundamentally, is a contract giving a lessee the right to use a specific asset owned by a lessee for a period of time in return for payments. Key criteria. There has to be an identifiable asset, and the lessee must have the right to control the use of that asset, meaning they get substantially all the economic benefits and can direct how it's used.
Okay, and how are leases classified now?
The core classification for the lessee is between an operating lease and a finance lease. Think of a finance lease as being economically similar to buying the asset with financing. An operating lease is more like a simple rental.
How do you tell the difference? What makes it feel like buying?
There's a set of criteria, often remembered by the mnemonic ONIes. If any one of these five is met, it's generally a finance lease. Ownership transfers to the lessee by the end of the lease term. The lessee has a written purchase option they are reasonably certain to exercise. The net present value of the lease payments and any guaranteed residual value equals or exceeds substantially all, think 90% plus, of the asset's fair value. The lease term is for the major part, think 75% plus, of the asset's remaining economic life. The asset is specialized such that it has no alternative use to the lessor at the end of the term.
Okay, so meet just one of those, and it leans towards finance lease if none are met.
Then it's generally classified as an operating lease unless it's a very short-term lease, less than 12 months, where there's a practical expedient.
And the big change is that both types now go on the balance sheet.
Yes. For both operating and finance leases, the lessee recognizes a right of use, ROU asset, representing their right to use the leased item, and a corresponding lease liability, representing the obligation to make payments. This calculation involves determining the lease term, identifying all the required lease payments, and discounting them back to present value using an appropriate discount rate.
So balance sheet impact is similar. Where's the main difference then?
The main difference lies in the income statement expense recognition. For operating leases, the lessee recognizes a single combined lease expense, typically on a straight-line basis over the lease term. It smooths out the cost, similar to how rent expense used to be recorded.
Okay, one line item for expense.
Right. But for finance leases, the expense recognition is separated into two parts. Interest expense on the lease liability, calculated using the effective interest method, so it's usually higher in earlier years, and amortization expense for the ROU asset, often straight line.
So the total expense pattern over time will look different.
Exactly. Finance lease expense is typically front-loaded higher in the early years and lower in the later years compared to the straight-line expense of an equivalent operating lease. This difference can significantly impact reported profitability trends and financial ratios.
That's a key distinction for analysis. What about cash flow?
Also different. For operating leases, the entire lease payment is typically classified as cash flow from operations. For finance leases, the payment is split. The portion representing interest is cash flow from operations, but the portion reducing the principal liability is classified as cash flow from financing.
Another important difference for analysts, and I assume there are hefty disclosures.
Oh, yes. Lessees have to provide extensive disclosures, both qualitative descriptions of their leases, significant judgments made, and quantitative breakdowns of lease costs, maturity analyses of liabilities, weighted average discount rates, and lease terms. The goal is full transparency about a company's leasing activities and obligations.
Wow, that was quite the deep dive into the world of liabilities, from simple payables to complex leases and bonds.
It really covers a vast territory, doesn't it? But if you think about it, understanding liabilities connects everything. It's about the promises a company has made based on its past actions, the obligations it faces today, and how those commitments shape its future strategy and financial health.
It's more than just debt. It's a reflection of their entire financial structure and operational commitment.
Absolutely. It reveals so much about their financial strength, their risks, their flexibility. You really can't understand a company's full story without digging into its liabilities.
So the next time you look at a company's balance sheet, remember, it's not just a list of numbers. It's a complex tapestry of obligations, big and small, short-term and long-term, that truly define its financial reality. What hidden promises or potential pressures will you be looking for?